Welcome to Idea to IPO. Hello, my name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley for many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 100,000 members among all our meetup groups all around the world. We've organized, promoted, and produced over 2,437 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, networking events, and more. These days, we're 100% online. We have an event nearly every day of the week. Check out our schedule at ideatoipo.com. At this point, I'm going to hand it off to our distinguished moderator, Jason Putnam-Gordon. Jason, take it away.
Thank you, Rob. It's great to be here today. It's great to be here with a fantastic panel. I want to thank them for coming, as well as thank the attendees for being here. As Rob mentioned, my name is Jason Putnam-Gordon. I'm a venture capital and emerging growth company attorney with Polsinelli. Polsinelli is an Am Law 100 firm with over 900 attorneys here in the United States in over 20 different offices. My practice focuses on emerging growth companies and venture capitalists as they deploy capital in artificial intelligence, robotics, IoT, and health tech related ventures. Today's panel is fantastic. We've got Ajay Chopra from Trinity Ventures, Bill Reichert from Garage Technology Ventures and Pegasus Tech Venture, Kumar Sripadam from Elevate Capital, and Nunu, who's going to save me from butchering his last name, at Grisham Robotics Venture Capital and Strive Capital.
Strive Capital, yeah. Yeah, that's the main one.
And Strive Capital. Before we begin the panel discussion, which is going to be focused on how to find the right investors for the long term, I want to go over some structural considerations today. So what we're going to do today is we're going to have an hour-long panel discussion. During the course of the panel, if you've got questions, please utilize the Q&A function. Please do not utilize the chat function because we could lose those comments. I may remind you during the course of the discussion on that. At the end, after that hour, we're going to take about a half hour of questions. Hopefully, we'll be able to answer them all. There's a good chance we won't, in which case we encourage you to contact one or any of us, whoever your question is directed to afterwards. As Rob mentioned, today's discussion is going to be recorded. So if you missed some or all of it, we'll follow up, so long as you have registered, we'll follow up with you and provide you with the recording. And the other thing to note is that we've got an audience survey. I'm going to wait about 20 more seconds for folks to fill that out, but it looks like we've got about 70% of the people in attendance filling it out. It's going to help us understand who's in the room so we can tailor the conversation to you. We're going to wait 10 more seconds and then we'll close it and I'll read off the results. And then I'll allow each of the panelists to introduce themselves, tell you a little bit about themselves, tell you a little bit about what they invest in their background. And I'm sure this conversation is going to carry itself. I'm looking forward to it. All right. So let's see. We've got about a third of the people are here in the Bay Area, which is where I am. I'm in San Francisco. 7% are elsewhere in California. 30% are elsewhere in the US. We don't have anyone from South America today, 10% from Europe, 10% from Asia, 1% from Africa, and then about 3% from somewhere else, which when I put it together originally, I thought that would mean either space or maybe under the ocean, but I've come to,
Antarctica.
yeah, it's Middle East and other things is typically where people answer that. We've got 55% first-time entrepreneurs, 16% serial entrepreneurs. No media members today are members of academia. We've got some folks who are already at large corporations. We've got some angel investors. We've got 3% are attorneys. We've got about 13% are at a startup and then 16% are in another. And 65% are interested in seed stage investment. 48% are in early stage investment. Growth rounds are about 13% and late stage and 6% with an undesignated 16%. So with that in mind, no one has come to hear me speak today. I'm going to turn it over. Maybe I'll let Nunu start by introducing himself and then we'll go around the wheel.
Sounds good. So I am indeed a venture partner at Grisham Robotics, but my main role is as the managing partner and founder of Strive Capital. We're probably the first early stage, analytically driven venture firm here in the Bay Area. We started operating in 2010. So we actually use analytics engines that help us both with deal sourcing and due diligence. I'm now on my second fund there. We've done investments that you might have heard of, such as App Annie, Gusto, Rubrik, DraftKings, Robinhood, and a few others. Very focused in Series Seed and Series A. Also very focused around consumer software and consumer-like enterprise software. So what people would call bottom-up software as a service, consumerized enterprise, etc. On top of it, and you might see underneath Tech Decipher, decipheredshow.com, I have a podcast that I do with my co-host, Bertrand Schmidt, who's the co-founder and now chairman of App Annie. Actually, we're about to release our third and last episode of our software as a service trilogy, which I think is like our episode 20 or something like that. So having fun doing that.
Fantastic. Bill?
Hi, I'm Bill Reichert, and I'm co-founder and managing partner at Garage Technology Ventures, which is a seed and early stage venture capital firm here in the Bay Area. We're focused mainly on software, mainly enterprise software with sort of an AI, big data intelligence kind of spin to it, is mainly what we're doing. But we've been open to pretty much everything, material science, med tech, health tech, at the early stage. Our probably our most famous company, which goes back way back when, is Pandora. We were the first investors in Pandora, but one of my favorite companies is a global success story called Delight Design, which has lit up over 100 million families around the world using solar rechargeable lanterns to provide electricity to people who are off grid. So we are pretty much all over the place. And then I'm also a partner at Pegasus Tech Ventures. We connected up with Pegasus a few years ago, one, to launch a global competition called Startup World Cup, and two, to invest in emerging companies all over the planet. And again, in Pegasus, we invest end to end. We invest in raw seed stage, early stage startups, up through pre-IPO, and pretty much all over the world. So we're investors in a whole bunch, over 180 companies, many of which we are hoping someday will become brand names, and investors in several companies that are already brand names, including SpaceX and Airbnb and 23andMe and SoFi and several others. So I look forward to this conversation and wish that we were all together in the same room, being able to talk face to face, but this is as good as it gets for these days. So great to be here. Thanks.
I am not, because the last time I was in a room with Billy, he hit me.
That's not true.
It's on video.
Sure, you
it
deserved
is on video. It is on video.
I think that was 2 times ago. It wasn't the last time.
We're glad to have Bill here today.
Okay.
Jay, tell us a little bit about yourself, if you wouldn't mind.
Hey, so I'm with Trinity Ventures. Trinity is actually a long-standing firm in Silicon Valley, 34 years old. We are investing out of Fund 12. We are a $1 billion organization, long-standing in both consumer and as well as B2B. Fun fact, one of our first investments, I was actually not with the firm at that time, it was Starbucks. So we were the first investors in Starbucks very early. And so we have a consumer line of business. Some of the investments we make in that area are primarily in D2C or marketplaces. So companies such as Fitbit, Zulily, ThreadUp, Turo, those kinds of companies. And then we're also very active on the B2B side, primarily SaaS investments, companies such as New Relic, TwoMogul, Auth0, Outreach. And some of the sector-specific areas that we like are real estate tech, fintech, healthcare IT. Those areas in particular are of interest to us right now. But we are all early stage. So every company that I mentioned here was either seed stage or Series A. We do a few Series Bs, but largely, the first institutional check in a company.
Well, fantastic. We're happy to have you here today. And Kumar?
Hello, everyone. I'm Kumar Sripadam. I'm a general partner at Elevate Capital. Elevate's on its second fund right now. The first fund was in 2016, and the second fund is just, we are just closing the second fund currently. Our focus has been on women and underrepresented entrepreneurs. And on the technology side, we are on broad tech, obviously, and with enterprise applications, software, infrastructure. We about 70% in broad technology, and healthcare and med tech about 20% or 25%, and 5% on some consumer related companies. We also work actively with TIE, and if you guys are aware of TIE, TIE is a nonprofit entrepreneur tech organization, and we syndicate with a lot of TIE angels and other VCs as well. We are a seed to Series A, and I don't think we have done any Series B. Definitely do all the follow-ons and everything. One of our strong tenets is mentor capital. We recruit a huge team of mentors to work with the companies and make sure that we can get them to be successful and get over the obstacles as they go through. And I'm also currently a TIE Silicon Valley board member and the chair for TIE Angels in Silicon Valley, as well as I was the convener for TIECon, which just finished in September. We had over 7,000 plus attendees. It was a virtual event, and many of you might have participated or known about it. And it was a very big success with a lot of marquee speakers and many tracks and content and boot camps and everything. That's it.
Well, wonderful. We're very glad you're here today. So today the question is going to be about how do you find the right investors for the long term? Ajay, you and I were chatting before this panel discussion. You articulated a framework of 3 or 4 sort of pillars of which your sort of general advice. What I'd like to do is maybe have you share that with the group and then have the other panelists talk at a high level about those pillars, and then maybe we'll add some pillars or modify them a little bit and then expand upon them through the course of our discussion today.
Yeah, sure. Be happy to do that. Yeah. So, I was mentioning to Jason earlier that, the advice that I would give to entrepreneurs when they're looking for money is the same advice that we give to our founders who we have already invested in when they're doing follow-on rounds and looking for, the next venture firm or partner to get involved with their company. And I think there are 2 levels to it, I would say. The basic level is just blocking and tackling. So make sure you take care of where I say the 3 essentials, which is sector, stage, and conflict, or shall we say lack of conflict. So make sure the investor you're going after is interested in the sector, has shown the partner, not just the firm, but the specific partner that you would like to target has demonstrated interest in that area. All of us, as you noticed in the introduction, declared the areas of interest to us. So it's not very difficult to find that. It's all on different. You can just look that up on the web. And then the stage. So make sure that it's the stage at which the partner is specifically interested. The conflict part is is something that I see often. An email come by where there'll be a deck attached for a company that's directly competitive with somebody that some company that I've already invested in. So it doesn't make any sense to waste your time. I'm not going to invest in a competitive company. Very few venture firms do. So that's kind of like the base level. If you're lucky enough to have multiple term sheets, then you need to start to dig into chemistry. The venture relationship, especially at early stage, like we invest in Series A or seed, is going to last 7-10 years. These days, actually, the time to exit is lengthened. So in many cases, that's going to be longer than most marriages. So you better get to know the partner fairly well. Make sure there's good chemistry. Make sure there's compatibility in thinking, and equally importantly, make sure they can contribute more than just money, because money is fairly easy to get these days for high quality entrepreneurs. So I'll stop there and love to hear other people's opinion.
I'll follow up on that and agree with everything AJ you just said. 2 additional items that are quite important. 1, do your homework. I think you sort of talked a little bit about it, but if you're sending a deck to a firm where there is a competitive angle, or if you're sending a deck to a firm that doesn't even invest in your space, that's just silly. You'd be shocked how many calls I take, and sometimes they're first calls, and people don't have a clue about me. They have no clue about my firm. It doesn't stand well, because then the pitch is just the wrong pitch. There's very little context setting, and we all like to feel special in some ways as human beings, so that you have no clue about who I am. Why should I care about your startup? So that's one important element of this. The second important element is the element of capital as well. Obviously, some firms have more capital than others. And so if someone is saying, I'm coming in and I'm putting a $3 to $5 million check in you, but we can go up to 10 million, understanding of what that actually means. Do they have the capacity to go up? But I totally agree with AJ in saying that at a certain point in time, capital is not enough. Even if you're dealing with a firm that has a lot of assets under management, at some point they'll stop being able to follow up, right, and follow on for a variety of reasons, because there's some limitations in their own fund, or because there's limitations in how much money they can put into a company, et cetera, et cetera. And at that time, what really matters is really the person that you're dealing with, the partner you're dealing with. And as I always say, the only thing you know for sure, in particular, if we're talking about the lead investor, is the partner you're getting. And that partner likely will be on your board, potentially could be a board director. In some cases, it might be a board observer, but it's certainly someone that will have a lot of importance to you in the future. And really understanding not just chemistry in terms of, do we get along, can we have beers together, but how does that partner function? How does that partner make decisions? What cues does that partner have? What track record does that partner have with other entrepreneurs? And obviously that comes much later in the due diligence piece, where the startup actually needs to do due diligence on the firm, needs to do due diligence on the partner, needs to ask and should ask, can I talk to 2 or 3 other entrepreneurs that you've invested in? Maybe a mix of people that failed and people that succeeded. How do I get a feel for you as a person, as a human being that's going to be on the board with me? I've been on the board, I think the longest I've been on the board has been 8 years of a company. I think my average tenure is around like 5 years on boards, which is relatively high. And you will have to go through a lot of difficult decisions. And not all decisions that the partner of the firm will make will be in the best interest of you as the CEO founder, or you as the founder of the company. Hopefully they'll be in the best interest of the company. And so understanding that distinction, understanding the distinction of what the duties are, also of what fiduciary duties actually mean, of what are the interests of the partner that works with you after investing is pretty vital.
Mm-hmm. So happy to follow up and jump in here. Yeah, so the challenge for most entrepreneurs is not really deciding between VC alternatives that they've got, because most entrepreneurs actually do not have a lot of alternatives. God bless you get competing term sheets,
yeah,
but that's going to be pretty rare. I hope, may you all get competing term sheets, guys. I really hope that's true. Your reality, the reality for most entrepreneurs is, how do you get to the investor who is going to say yes? And absolutely agree, with Ajay and Nunu about, importance of doing your homework. Nobody's going to say yes if you show up on a pitch and you are clueless about who's on the other side. So, Nunu's point about, if you haven't done your homework and it shows up, you are not going to get to yes. But the challenge for you is, most entrepreneurs, this is a really unnatural act, going out and raising money. It may even be hard for you to just to be a salesperson if you're an engineer by training. It is, it's hard enough to be a good salesperson in terms of your product you're offering, but then selling to VCs, selling to investors, it's such a weird thing. It's really hard to train, and it's really hard to learn from a book. And so you're going to learn on the job. But what you really, I'm assuming almost all of you are going to actually start with angel investors. Most of you are going to wind up initially getting initial capital from angel investors, and or maybe from an accelerator program, which hopefully has a good liaison with you. And so I think the most important thing for a lot of entrepreneurs is to understand you're not going to be able to do it alone. It's going to be really, really important to leverage, your network and to tap into your network. This is not an engineering exercise. This is a sales exercise. And you've got to find everyone in your network you can possibly find who is smart about where sort of the next level money is. Hopefully you've got some angels who are really well plugged in, who can help evangelize you into the venture community and or to other angels. But it may be sort of multiple steps before you get to venture capital. It may be, you know, sort of accelerator, angel, VC, you know, small fund, bigger fund. So understand, you know, if you got a brilliant idea and a great deck, it's not likely that you're going to get, you know, Andreessen Horowitz or Sequoia in your initial funding. But stepwise, through your network, through your connections, you know, you can build that sort of connected network to eventually get there. And so my encouragement to, you know, all entrepreneurs is, you know, get smart people who've done this before close to you as advisors, as part of your network, as part of your evangelist group, and work that to get to the right investors.
Thank you. Just following up on what Bill said, I think, you know, in most cases, you would have probably raised money with some early investors, either super angels, smaller funds, maybe, you know, micro VC funds or whatever. I think you should use and follow on the leads from these guys to help you evaluate who you should go for next. And that network, that information is very valuable. You can lean on them to sort of guide you to, you know, what are the VC firms you should actually go look and apply. Again, it comes back to homework, and look at those firms which are actually in your domain, have the expertise, and can actually evaluate you fairly as a problem solution company. Because if you are applying to a VC who has no knowledge of your background, I mean, it's a wasted effort and a lot of resources and cycles which are gone. And that said, you know, once you have sort of reached that stage and you're able to get into this, you know, get into that stage where you can actually having to discuss term sheets and stuff like that, you also need to evaluate what is it that they can bring you, what are the things how they can help you. I mean, some of them are good in the network, some of them are good in doing syndication, some of them may help you with execution, some of them may help you with you know, exit. So you're going to evaluate each of these investors on their strong capability. You know, not all of them will have all. Hopefully, there might be some exceptions out there, but that'll be great. But you need to evaluate them for what it is that they can bring you onto the table for you. And the most important thing is, what is the time horizon they would like to invest with you? You know, are they the follow-on type, or will they take you up to a certain stage and open the doors for a Series A and a Series B? That's very critical. And, you know, that kind of help is very useful as you go on and execute. But all in all, lean on your advisors, lean on the people who have put some initial money in you to open these doors and help you make the decision how to find the right investor.
Yeah, if I could just double click on that, you know, I was talking to Jason about this earlier. You know, I was an entrepreneur before I became a VC, and was fortunate enough to grow my company through IPO. But at the very early stages, this was an era when information about venture capitalists or any money was not available at all easily. So, you know, all I knew was the lawyer who helped incorporate my company from Wilson Sonsini, and you know, a few high net worth individuals. And I just like basically pestered anybody that I knew with money to give me the initial 250K. I think this is what Bill was talking about, right? So kind of like convinced them that, you know, I was worth it. And then some of the very first introductions that I got to other high net worth individuals came from the counsel, the lawyer, who was my corporate lawyer. So, you know, Bill had a really good point that even before you can think about venture capitalists, you have to think about, you know, how do you sort of walk, crawl, run, right? So, or crawl, walk, run. How do you like sort of get going in the very initial stages and find the few people that just trust you and get the initial capital, so you can show some progress to even if you go to Thai these days, or YC, they expect you to have a product and a good story and maybe even customers. So that's further down the road than what you might need at step one. So that's a really good point.
Mhm.
So one of the things I'd like to try and do, since we've got about 55% of the room is first-time entrepreneurs, is to try and give them some nuts and bolts on how they can execute on some of these things. So some of the things that came up would be homework. Doing homework for an angel is maybe a little bit different endeavor than doing a homework for a VC. Will be easier these days because you'll see all of the information published on Crunchbase or PitchBook. But maybe if the panel would share a little bit of information about how these entrepreneurs can start to execute and do their homework and diligence, as well as timing. Where you brought it up in one aspect, but another aspect is typically start looking and building these relationships before you need the money, so you got the trust and rapport, so that you'll be able to get the deal done when it's time.
I mean, if you start, I'm part of my brain is a hacker brain. I'm a computer engineer by background, and I'm always looking for the shortcut, whatever. I mean, there's some really basic things, right? If you're looking at investors and firms, go to their website, see their portfolio companies, see what they say there. Google the people that you're talking to. Angels, if the angel's very prolific, would also have quite a lot of persona. If you're not on Angel List is a really good source to look at angels. If the angel's relatively legit, they will be there. They'll probably have named, what investments have they made, what exits have they had, et cetera, et cetera. Look at videos. Everyone is out there right now doing panels, et cetera. So now COVID is actually even better. I mean, the inventory you'll have to go through to figure out what we are passionate about, et cetera. And we're all bright people, but obviously we also speak a lot, and therefore we probably come back to the same points over and over again. So if you watch a little bit of a show reel, so to speak, of what we speak about, we normally have the same pet peeves, we normally have the same areas we focus on, et cetera, et cetera. So that's actually really basic, and nobody does that. That you can literally do in 15 to 20 minutes, like literally.
I'll go back to the point with Jason. Oh, sorry, go ahead. No. Yeah.
No, sorry. Just to finish, and happy to pass it on. And then you have to go into your own network, right? Which is go to your network. Who knows this person, right? Does this person that is already on my network know that person well? Is this someone that I actually can reach out to get more context on this other person that I'm trying to reach out to? And there's a bunch of great hacks. And the closer that person was to an investment from the other person you're trying to get to, the better. So if, for example, it was a previous entrepreneur that got funded by this guy or this girl, if it was potentially someone who actually worked in this firm or had some connection to this firm, all of that's super mega valuable. So again, there's a bunch of hacks. Basic desktop research is where you start.
I'm just going to go back to what Jason talked about, homework and first-time entrepreneurs. I think for first-time entrepreneurs, it's important that if you've not done this before, that you're going to get a finite chance, whoever the investor is, whether it's angel, whether it's a VC, an opportunity for you to present your company and what you want to do. And you want to make the best of it. So make sure everything in that presentation, or at least you have all the information you need for all possible questions you can expect. So do your homework, whether it's problem, solution, competition, what's your business model, what's your exit, who's the team, what are their strengths, how does the problem get solved, the pipeline, and where you would like to do trials, all those things which normally is there in every possible website as to what you should have in your presentation, in your pitch. But more importantly, try to find an anchor lead in your as an early investor or an advisor to help you guide through this pitch, help you put this presentation together so you look very professional when you go in front of the investor. Now, there are accelerators like Alchemist, there's Y Combinator, there's so many other accelerators available who actually help you achieve this. They coach you, and there's some paid services and there are free services. Go through that mentorship program and get yourself completely prepared. So when you do go there, you have that one single chance where you can make good of it and drive it out of the park.
Mhm. Yeah, to elaborate on what Kumar is saying in terms of tools and hacks, as is saying, just, and we haven't gotten into pet peeves yet, but we can go down this path a little bit, which is to say that a lot of particularly first-time entrepreneurs, you want to bury us in a comprehensive, sort of explanation of your company. And, sort of from day one, because you figure, because all of the pitch guides say you got to talk about, the team and the technology and the traction and the go-to-market and the financial projections and your milestones and your, and so you try to flood us with all this stuff. And that generally doesn't work because it's going to be a lot of sort of stuff that we're not going to wade through. I'm going to let you know a dirty little secret about venture capital that we generally do not like to say out loud in public forums like this. But, because just between us as friends, let me share with you the harsh reality you guys have is that for the most part, VCs spend on average or certain, on average, maybe or a median, whichever statistic you want to use, but we spend 10 to 20 seconds on each inbound that we get. I mean, that's the amount of time that we have to spend to decide, do I bump this to one of my partners or associates? Do I dig in deeper? Whatever. But you got to get it across in 20 seconds. You got to get across, I got to pay attention to this company. So you can't say, dear Mr. Investor, it was recommended that I connect with you. Please see the attached PowerPoint presentation. That ain't going to work, nor is this huge email going to work. You've got to figure out what is that amazing thing about your company that differentiates you from everyone else, that is clear and compelling and credible, that you can get across in 20 seconds. And that's got to be sort of at the top of your email or at the beginning of your coffee shop conversation, or at the top of your website, or however you're getting it out there. What's the 10 or 20 seconds that your evangelist friend, advisor, angel investor can share with his or her friends that's going to get them to say, oh, that's really interesting. I'd like to follow up on that. So understand that the process of connection is, the step-by-step to get to the next meeting, or to get to the next minute of conversation, or to get to the right to send a pitch. So boil your value proposition down to something really clear, really concise, really compelling, and that gives you permission to have the next conversation.
I think that's a really good point. The other thing, just to add to that, is who is making the introduction. That's equally important. So if you can get someone that knows this person that you're targeting as a potential investor really well at a personal level, or has expertise in that sector in which your company is, that really matters. Because if I get an email from someone credible, let's say in healthcare technology, I'll certainly look at it more carefully, maybe a minute and a half rather than 20 seconds. Look at it. The other thing that I would say is once that email triggers the first meeting, that point is a real opportunity, and it's sort of like a one-time opportunity for you to make an impression. Because the other dirty little secret about venture capital is that we go through tens of meetings in a given week. On a per partner basis, maybe a dozen or more. And then the following Monday, we sit down with all of our partners and kind of like decide which are the one or two companies we're going to execute on, for the following week. So how do you, in that very first meeting with perhaps just one partner and maybe an associate along with them, make an impression that will actually get you to the next level, right? The important second meeting. And what I often say is, it's all about practice, right? So you just have to work with your advisors and people that are already involved with your company to just rehearse your pitch in such a way that the crisp value proposition that differentiates you compared to anybody else that may be in that sector really comes out. Okay, it has to stand out, and don't get lost in a muddle of trying to go through every aspect of your business. Just talk about the crisp value proposition that first meeting. Your objective of the first meeting is only one, which is to get the second meeting. Okay, because if you get to the second meeting, you know, that whole discussion with that venture capitalist or the venture firm is over. And the last thing I would say in this respect is, you know, after you have sort of got your pitch rehearsed and you have made a selection of which venture capitalists are the best fit for you in terms of sector, stage, lack of conflict, you probably want to make a prioritized list of in which order you would go and pitch them. You probably don't want to pitch the most likely VC for you first, because you want to rehearse on a couple outsiders. So, you know, at the very beginning, you should rehearse with your advisors or people that are involved with your company currently, including existing board members, if you have any. And then you should go to some venture capitalists that are generally friendly, maybe less likely to do the deal. It may not be a perfect fit for them, but they'll give you very good feedback and advice that will just help you refine your pitch that much more when you go to the real targets that you want to get.
Yeah.
Ajay, I don't know if you could have sort of put together a better segue than that. You read my mind. So we're about 40 minutes into the conversation. We've talked a lot about how to get that first meeting, who you should be sending those initial sort of pitches and requests out to. I'd love to hear from the panel some input on what entrepreneurs should be thinking about for the second meeting and for the diligence process on their end, you know, once they've kind of gotten their foot in the door, and hopefully it seems like there's a fit.
Yeah. So happy to you know, jump in on the you know, the partner pitch side of things. And one of the things that I just warn every entrepreneur about is to understand that a pitch is not a presentation. And so one of the dangers that you're going to have as you put together your pitch is you're going to assume that you've got whatever you've got, your 10 slides or 12 or 15 slides, and you're going to be able to stand up there and present your, you know, your 15 slides. And most likely that ain't going to happen. Most likely what's going to happen is somebody's going to interrupt you and ask you a question, ask you a follow-on, and you're going to lose your train and you're going to get flustered. You got to be ready for the fact that a pitch is not a presentation. It is an interactive experience with investors, and it is critically important that you be ready to respond to investors, because I'll tell you, I mean, it's okay every once in a while if you're pitching and an investor says, but wait a second, what about XYZ competitor? And every, you know, you can say, yes, we're going to talk about that just in a couple of seconds. I'll get right to it. You can say that sometimes. But if you keep on deferring, if you keep on pushing back on the investors when they have questions, you've got to, you know, that's going to be a problem. So you've got to be ready to be interactive. And one of the things that was one of my biggest sort of revelations, epiphanies about the whole process, having been started or restarted four companies as an entrepreneur before I became a VC, was to appreciate that you got to have a good pitch, you got to have a good presentation, you got to be clean and smooth and clear, but you win or lose in the Q&A. You win or lose in the Q&A. And if you blow the Q&A, it doesn't matter how beautiful your slides are, it doesn't matter how practiced your pitch is, you've got to be ready to be good at Q&A. So in addition to knowing your pitch, practice this, you know, Q&A. Make sure you listen, you know, and as Ajay was saying, start with friends. So, you know, start with friends who will be willing to ask the questions that pop into their heads. And, you know, make sure you extract from them all the, you know, areas that they need clarity on and all the questions that they've got. So you are ready to either preempt those questions in the pitch, or you're ready with a good, crisp, direct answer when the question comes up. So practice and understand the Q&A part, not just the slide presentation part.
This is a great segue for what I wanted to actually say. It is shocking to me how ill-prepared some CEOs still are in their pitches. You know, you would ask DAUs ever MAUs, average time per session per user per month. We would ask, how's your cohorts changing over time? What's your day 30 retention? What's your 1 year retention if you already have 1 year of cohorts, et cetera, et cetera. And some people look at us like we have just said something that is totally shocking. No, what that shows me is you don't understand your business. In particular, if it's an early stage business, you need to understand how your traction is working, your retention, your engagement. You need to know core numbers that someone might ask you. So again, to Bill's point, that level of preparation in Q&A is pretty vital. You need to be prepared for the interaction, right? Number 2 point that I would like to make, and I think to Jason's question, you need to have a data room ready. I mean, you're starting to pitch me. I say, okay, I'm excited about you. Can you send me data on your cohorts? Can you send me funnel analysis? Can you send me something that I can take a look at? Do you have any competition analysis? We'll do our own outside in, but you have some competition analysis that you already done, right? And again, you'd be shocked how very few startups have anything ready, right? So it's very clearly they're scrambling at that point, right? So it's like they're ready to go, but they're not really ready to go. And it will take them like a week or 2 weeks to get back at the table. If there is momentum in the discussion, a week or 2 weeks is actually a long time. And it does show us that you sort of not fully prepared. There was some question that I saw in the message board earlier around NDAs. We don't sign NDAs normally in Silicon Valley, right? If we are signing NDAs, it's very, very late. Very late in due diligence, and we're almost sure we're going to invest, etc. And it will be part of the term sheet. Is normally one of the clauses that is binding, which is the mutual confidentiality in term sheets. But normally we wouldn't sign it. But have your data room ready, and make sure there's maybe a level that you're willing to share, maybe there's a level that you're not willing to share, etc. Final thing, most exciting thing. Everyone would tell you that there is a way to do the meeting. You know, to Bill's point, it's very interactive. There is a presentation. You should be able to release your agenda on a presentation and just address the questions. You should be willing to go from it's a 30-minute meeting to it's a 1 hour and a half meeting. So you should be ready for all these things, right? The thing that you probably, if you asked around all of us around this table, what was the most memorable pitch you've seen over the last 6 months or 12 months? Likely it wasn't a classic pitch. Likely it wasn't someone who came into the room, put up their last laptop, they were ready to go, they went through their sequence, we asked questions, we had a good interaction. Likely there was something funky about it, right? There was something different that was exciting about it. There was a different angle. There was a hack almost in it. And for example, the coolest pitch I've seen probably in the last year was a bunch of, Gen Zers coming into my office, no laptop, their mobile phone on. And they're like, they were already connected to our Apple TV, and they just beamed up their presentation, and they showed their first slide on the presentation. They said, by the way, let's just do a demo. And it's a consumer app. They went into the demo straight up, and I was like, I understand what you do. They just spared me out of 5 slides, superfluous slides of information that I absolutely didn't want to go to. I was like, I got what you're trying to do. I just got it, okay? And then they went back to their slide deck, and I had a few questions, and they were like, in whatever, and blah, blah, blah. And that was the most memorable pitch that I've seen. These guys have raised a series, I'd call it a seed 1A from Sequoia a couple of months later, right?
Yeah, just to pick up on Nuno's point, some of the best presentations, some of the best pitches that I have seen do not have a presentation. In fact, one of the things that we have started doing when we prepare our CEOs for the next for their next round is to have them pitch us, like the partner that's on the board. What I do is I have my CEOs pitch me without a presentation, okay? Because if they start to go in some funky tangents and not on top of what really matters and differentiates the business, the presentation is not going to help. I think keep in mind that when venture capitalists are listening to your pitch, they're looking at you, not the deck, okay? Because they want to hear what you're saying. The deck is an aid, so they have a visual representation to remember what you just said. So that's one part that's very important. Try to do the pitch with the initial advisors and maybe the friendly VCs without a presentation, and see what are the key points they pick up that are interest to them, that they think differentiates your business from other competitors they've seen. Then you can incorporate them into your deck. The other thing I would say is, how many times have we seen decks that have got like, 20 lines on each slide, and like, very fine point, okay? It's crazy because, then you're distracted as a venture capitalist. You're looking at this entrepreneur, but you're trying to comprehend what's on that slide. That's a complete distraction. It's taking away from everything you prepared, right? You should just talk to what you have in your mind, but put as little as possible on the slide that guides you to what your talking points are. That slide is a guide for you and something that, quickly the venture capitalist can memorize and say, okay, that's the essence of what you just said, and then move on to the next slide. We have invested actually in some of our better investments have been, presentations without a deck, or I should say pitches without a deck. So.
Thank you.
So just to add more color to what AJ just said, picture is worth 1,000 words. So, try to see if you can convey the message with some graphics out there instead of so much verbose that people just get busy looking at the slide. And if you can put the value prop out and make the case for why you should fund your company just by the narrative, I think that's what it is. That's what will keep it engaging. That's what will keep it moving forward. Now, that said, there will be always questions about, some numbers, or have you looked at this, or what do you think of that? Do have those slides. Have that as a backup. What does your pipeline look like, or who are you talking to, and how does your business model look like? And, have that, bring that out, and then give that out again in the narrative so you can keep it engaged. The other point I wanted to make was sometimes discussions, maybe, they might set a 30 to 45 minutes for your second meeting here, but it might run long. And you need to be prepared for that. Just following up on what others said, make sure it's engaging enough that, if you ever go into a very interactive 90-minute discussion, you have all the points to answer. And if it's another team member who is going to be with you, make sure you guys are in sync and you kind of practice that. And there should be some team dynamics which reflect that. So the second meeting, if you're making it, it's a very important meeting because obviously there's interest enough, and make sure you do good use of it to get to the home run.
It's very funny that you should mention that, because I work with at Christian Robotics. I am a venture partner, founding partner. There is a guy called Dmitry Grishin, who, lack of a better analogy, is the Mark Zuckerberg of Russia, or potentially even the Pony Ma of Russia, because he created Mail.ru. And Dmitry, I always warn entrepreneurs when we're having a due diligence meeting with Dmitry. Normally it's for 1 hour and a half, but just save a little bit more time. Yeah. And sometimes it's 2 hours, 3 hours. And I call them the Dmitry shotgun machine meetings. And people get out of there and they're literally, obviously they're exhausted, but they're also like, oh, this didn't go well. And I'm like, no, it went incredibly well. Right? Because if he wasn't interested, right, he wouldn't have asked you all these questions, and we wouldn't have spent 3 hours together. You're confusing tonality with interest, right? I think it's two different things, and normally those are the investments we end up making in this case, right? So every partner has their thing. I'm probably a little bit nicer. I'm more tough love, right? Some guys are very aggressive. They ask a lot of questions. That doesn't mean that the meeting is going wrong. It just means, so don't take it personally. Answer the question and have the debate. If you don't know, you don't know, right? Don't pretend you know. Credibility can be, the other thing is credibility can be eliminated in one sentence. So I would say the one thing you need to be careful is never say something that is validly untrue or a lie that can be easily verified. Never do that, right? Because you'll be caught, you're done, right? It's not going to work.
Yeah, a couple of other things on the nuts and bolts. And actually, one of this is actually a question back to our panel. On the nuts and bolts, you heard a couple of people talk about that you're having a data room and having a data room ready and all that sort of stuff. For most of you who started out with angel investing, angels are generally a little easier on you, a little
forgiving.
bit less, in terms of the due diligence, in terms of a lot of the deep dive, and even in terms of board meetings and board governance. And I see so many entrepreneurs who get fooled into thinking that, and VCs are like angels just with more money, and that ain't true. It's a very different world you're going to move into. Now, maybe you'll find some good angels. Maybe your angels are really disciplined, but whether or not they're disciplined, you've got to be disciplined day one. You've got to start instrumenting your company at the beginning. So you have the data that Nunu is talking about. You better know these statistics, even if you're really early on, even if it's just right at the beginning of launch, you should instrument your company, have the data, keep the financials, start setting up a data room. And so you do not want to be in a situation where you're scrambling at the last minute to put together the data that VCs want. You should have it, and that will knock our socks off. If you're just coming up from an angel round into a VC round and you've got this discipline, this data room, you've got your company instrumented, you know your numbers, you know your unit economics, it will knock our socks off. And so that alone is going to be to your credit and going to get us, excited, in addition to, your value proposition and the chance that you're going to someday become a unicorn. The other point that we're touching on here is understand it's going to be, a lot of entrepreneurs wonder, well, how do they evaluate our team? They spend so little time with us, et cetera, et cetera. I mean, from the first moment we start talking with you, we're paying attention to the way we interact with you. And, it's a two-way street. You should be paying attention as well to how, what type of people we are. But, we're looking for this sort of right combination of persistence and, aggressiveness and urgency and resilience and confidence and optimism. And we're testing for, arrogance or delusional optimism, or, believe it or not, if you're too nice, we may be a little nervous. If you're a little deferential, I don't know if we want So there's a lot of things that we're trying to interpret in each of our interactions, on Zoom and email and follow-ups and timing. We're assessing the fit at the team level, in addition to the content. And then the question I want to throw to the audience here, or to my colleagues here, is the reality, the point that Ajay was making, that the slides cannot be complete. If the slides have a lot of text on them, then you're going to distract from you in the pitch process. So what we tell entrepreneurs is you got to have two decks. I'm sorry, you got to have two decks. You got to have slides that are presentation slides, and you have to have slides that are leave behind slides. Because the harsh reality is, at a venture firm level, we need a deck that we can share with our partners that is interpretable. And so the kind of slides that you're going to have when you're presenting are not going to have enough information on them for a leave behind. Yeah. So guys, how do you coach entrepreneurs on that?
Yeah, typically through an appendix is what I do, is, because I think it's difficult to manage two docs and things get lost. I want to add one more thing to what Bill just said. Yeah. And he may have implied it, but I want to be very clear about it. And that's the interpersonal dynamics between co-founders, okay? Because one thing we have realized with a long history is, one of the big reasons for failure, I think it's probably like number 2 or number 3 in our analysis, is that, the founding team comes together, and then after the financing round, they start to fall apart, the differences develop. And you can actually pick that up during the pitch sessions. Venture capitalists can easily pick that up during the pitch sessions if they're looking for it. So just make sure that, if the two founders are pitching together, that they're passing to each other. There's this enthusiasm in appreciation for the skills that the other founder brings to the team, right? That should come out very clearly. Firstly, it should not just come out, it should be there for you to have a good founding team. Let me put it that way. Because if it's missing, you probably want to have a different founding team along with you. So that's super important. The other thing that I think was implied, I think someone said that, fundraising is like a sales process. I would actually think of it exactly that way. And in fact, I would go a step further and think of it as pipeline management that you do when you're selling, folks. So what happened is, over the initial few weeks of your fundraising, you start to develop a list of people that are at various stages, just like in a pipeline, right? So some are really interested there, maybe even ask you to come in for a second meeting. Others may have said no. But there's going to be this large set, unfortunately. VCs tend to be, not very responsive. That would be just not responding to you, okay? So what we encourage our founders to do is to do what you would do in a sales process, is start a drip campaign, right? So every week, give them some interesting news if you want a new account and so forth. Like I had an example where there was a company called Bird Eye that I ended up investing in. The founder approached me at the very early stages, and I looked at, didn't quite like groove at the idea. He reached out to me, like 6 months later and said, hey, I'm at 1 million ARR. And I actually took an initial, call with him and sat down and everything. And I said, I'm not still 100% convinced. Let me kind of like think about it. For whatever reason, he didn't raise money. And about 6 or 8 months later, he said, now I'm at 3 million ARR. And, I sort of jumped at it, looked at it carefully, because one of the cardinal rules of venture is if something is working and you don't understand it, you better invest. Okay. So, because, it's not, those are the companies that actually break out. And, true enough, I mean, that company's really broken out. It's going to be a success story. But, this entrepreneur was basically doing, sales management, just doing a drip campaign, giving me good news. Every time something new happened, new contract that they won or whatever, a new area that they were addressing with their technology. So I think that pipeline management idea is worth considering if you're fundraising.
I think that's fantastic. And I don't mean to cut folks off. I think we've got maybe about 5 or 6 more minutes left in this portion. And I do want to touch on just the aspect of the startups diligencing the investors. What concrete steps can they take? Whether that's in view, Ajay, you and I talked about this before in terms of, speaking with portfolio companies that the VC is, some founders at portfolio companies. That's for one aspect. Maybe Kumar, we haven't heard from you speaking in a couple of minutes. Can you take that one, and then we'll circle to the Q&A. Before we circle to the Q&A, however, I do want to make sure that each person sums up their takeaway message as well as their contact information. So Kumar, I'll let you take that question and then we'll transition.
I think we talked about it during our discussion here, but the most important thing is what is the value this investor can bring to you? And, is it, how do they help you solve your tactical as well as your strategic objectives? Which portion of your problem can they help you and guide you through the process? Now, that said, how do you go about doing this? And is there any, just like investors do reference checks on companies, there's probably a way that you could probably also check on the VCs. First of all, you might want to make sure that they are good for the domain, they're good for the expertise, and even not so much as the expertise, at least are they good for the outreach, are they good for syndication? There are many of those aspects you can look at and say how they can help. And then, go away from traditional reference checking. I mean, just, follow some diligence process rather than, find out what are the companies they funded and how they work and how they had a good exit. Don't hesitate to go back to them and find out which of the companies failed and why. And maybe from that, you can get a lead on, as to what is it that you'll be expecting with this VC firm. What is their investment horizon? What do they expect out of you? Do they want something in 5 years? Do they want something in 7 years? Are they willing to ride it along all the way? So these are some of the things which you should have prepared and make sure you can execute on them when you start looking for the investor who's going to help you.
Maybe I'll start the round robin on final thoughts and takeaways. First and foremost, we haven't talked a lot about it, but the most important thing is that you're building a business. I mean, at the end of the day, you can raise money from venture capitalists, from angels, from strategics, from corporate venture capital arms, from private equity firms, from not raise money at all, make money yourself, etc. So there's many routes for you to be a success. And the first thing is build your business, build your team. You're going to start by building minimal viable products. You're going to start by building products. You're going to then get it to the next level and have a route in mind in what you're building. Don't just think about fundraising. Fundraising events are things that intersect, that augment you, that help you. They're not the be and all of doing this, right? You're not doing startups to get investment from VCs on Sandhill. You're doing startups because you want to build businesses in areas that you're passionate about. So that's number one. Number two, if you then do need to raise money from people like us, from venture capitalists, choose timing correctly. And timing, there's a lot of layers of timing. There's the macro timing, right? You shouldn't be talking to me if you're raising 500K and you have an idea and an MVP, right? Because normally I do Series C and Series A. So normally I'm not the right person you should be talking to so early. Then there's the more micro level of timing. And the micro level of timing is once you are engaging with us, you need to select what is the right time to approach certain different subjects, right? So back to the point, Kumar was just making. You can interview me as a partner. We're considering working together. I'm going to invest in your company. I'm probably going to join your board. Do you want to interview me? You can ask difficult questions. Have you ever had to replace a CEO in a company? How did you do it? Can you share with me, obviously, anonymized information around it? As I mentioned earlier in my conversation, I would like to talk to 3 or 4 entrepreneurs, a mix of entrepreneurs, people that failed miserably to people that were hugely successful. Could you tell me 3 or 4 people in your network that I can talk to? Obviously, all sorts of hacks in the LinkedIn, desk research, realm, talking people, seeing how they speak about things, etc. But you should do this at the right time, right? If you're asking me on a first conversation, 30 minutes, tell me if you've had to change people and CEOs on the board, I'm like, why do I need to tell you this, right? I mean, we're just getting to know each other. It's like, this is a first date, right? You're talking like we're about to get married, right? It's like, I'm not going to tell you this stuff. I mean, it's like, this is personal stuff. It's very intimate, right? So again, timing is pretty important, and managing timing is really important, which is the third part of the layer on timing, which is how do you manage momentum? We didn't talk about this, but all of us always get the same stuff, right? Which is, I'm about to close. I have someone interested. I have 3 VCs that want to give me a term sheet, etc. 9 months later, nothing. You still don't have the money, etc. You've lost credibility. I don't trust you. So you have to find ways to create momentum in discussions with VC firms and institutional investors that don't depend on just outright lying or making up stuff and creating buzz where it doesn't exist, right? So all of that we've all seen. So dealing with that is really important. Last but not least of my takeaways, and I'm going to finalize very quickly, the person. This is all a personal thing, right? Do I want to work with this partner or not? Is this partner going to stay long-term in this general partnership or not? Can I get along with this person? Can we make decisions together? The tough decisions, not the easy ones. If this is a runaway success, we'll all be rich and we're all great. But if this is going to be difficult, can I work with this person? If we're going to pivot, if we're going to almost fail, can I work with this person? That would be my last takeaway.
Yeah, I think, I actually want to go back to, because a lot of the audience here is seed stage, and maybe some of them are trying to form companies. Whereas we do mostly Series A's, we do see a lot of companies at the formation stage, and we have done some formation investing as well. And I see fairly often that entrepreneurs sort of fall in love with their idea, and even though it may actually not be a viable idea. So I think the piece of advice that I like to give you is that if you get a seed amount of money, let's say between $1 to $5 million or whatever, you're going to be committed to this idea, right? And it's going to take like 5 years of your life, okay? And if you do not truly believe there's a differentiated idea that can go long, your opportunity cost in executing that idea to a bad outcome is way more expensive than my $5 million. Let me make that very clear, okay? Because if you spend 5 years executing that idea, taking my $5 million and it's a dud, I lose $5 million out of $1 billion fund, but you've lost 5 years of your life that you'll never get back. So make sure before you dive into a startup that you truly believe that your idea is differentiated and you're completely convinced that it's going to stand the test of that differentiation. So talk to your advisors, talk to other people in the industry, other founders that have formed these companies before you launch in and start to make a commitment to venture capitalists, because it's a commitment. Once you raise the money, you're committed to building that company. So that would be my advice.
Want me to jump in? So yeah, my sort of single biggest takeaway for all the entrepreneurs out there, lots of stuff we talked about today, but the single biggest thing that you're going to have to do well in order to find the right investor is you're going to have to figure out how you stand out. And this is the same thing you're going to have to do in the marketplace. You got to do all of this other stuff well enough. You know, you got to be in legal compliance. You know, you got to pay your people on time, right? You got all this stuff you've got to do as a business person. But if you're going to succeed, there's got to be something about you that stands out. You know, and this is Ajay's point about this compelling value proposition that differentiates you in the marketplace and causes people to flock to you. So you've got to stand out, and that means you've got to be really effective at targeting the right investors with the right message and figure out how to get them excited about what you're doing. So you cannot just spread the peanut butter evenly across, you know, all of the aspects of your business and hope that investors are going to figure out why you're going to be a successful company. You've got to figure out what is going to make our hearts beat faster. You know, you heard Ajay's point about Bird. You know, they went from an interesting idea to $1 million in ARR to 3 million. And, you know, this was not an intellectual response that Ajay had. This was an emotional response that he had. He, you know, his response, the VC response is, oh shit, I got to get on this thing before it gets away from me. So you want to get an emotional response from VCs. If you are good enough at being clear and compelling about what you're doing, that, you know, you can get an emotional response of, wow, this is amazing, then you will self-select. You know, most likely you will then self-select to the best investors. They get you. You know, Nunu, you know, saw this app guy and they just had it and they had it down. Nunu got them. Nunu was excited. They got Nunu. Boom, right? So the key to that is to make sure that you can isolate, distill out what is really compelling, what is really exciting, what is most compelling about your value proposition that's going to cause customers and VCs to go, wow, that's amazing. Tell me more, tell me more.
Terrific. Kumar, do you have a takeaway? And then I'm going to have each of the panelists just convey their best contact information and how you'd like to be contacted, if at all.
Okay.
Mm-hmm. Mm-hmm. I think we're going to go back to that point of do your homework, do the homework well, and you get a finite chance in front of a VC or an investor. Make good use of that and make sure you're completely prepared. As Bill just said, you know, how do you wow them, right? And what are the things you can do to make sure that, you know, they want to come back and say, come on in for the second meeting. So find the investors who can understand the problem you're solving and who will actually can make a case of the opportunity you're presenting. And also look for those who will finally, eventually, when you do actually have the term sheet and the funding, get you to help you grow your company, help you reach your objectives, and help you succeed. And how I want to be contacted, email or LinkedIn.
Yeah, LinkedIn for me. Please write in the notes that we met or that you saw me or you saw us in this panel.
And for me, please don't try to communicate with me by LinkedIn. Please. You know, you can use my email. My email is fine. My email is reichert@garage.com. reichert@garage.com.
Yeah, my email is on our website, Trinity's website. You can also DM me on Twitter @Ajay Chopra.
Mm-hmm.
Fantastic. Well, thank you very much, panel. We've got about 15 minutes or so to take some questions. There are some queued up. This is a friendly reminder to the audience. If you've been using the chat feature, please resubmit your question via the Q&A, the question and answer function, so that we can hopefully get to it. I apologize if it looked like I was not paying attention to any of the conversation, but I'm running a lot of the back end, looking at the chat, making sure that everything else is working. So that's what I'm doing in the background. Mm-hmm. We've got some questions here. So I think even before this panel discussion, we were talking, there's some companies for which COVID has acted as an accelerant. It has really sped up their development, sped up interest. There have been some that maybe it's not affected whatsoever. Mm-hmm. What are you all seeing in terms of, you know, in Q2 and Q3 for performance where the companies have been negatively affected by COVID. And, what is the investment situation or scene look like for those companies? Is it a wait and see approach? Is it
I would say
One
there.
aspect.
Sorry, go ahead, Kumar.
Yeah, one aspect I think there's going to be a lot of discussion. I mean, that's a big discussion on its own about the whole COVID and the investment cycles. But one thing we look out for is the churn and how the companies are able to control that, and that shows how they've been able to keep the customers happy and move on. I think that's one of the important things. The second thing is their whole funding and whether they have enough dry powder to make sure they get through. So just 2 key points I thought of.
Yeah, I mean, I think that what we look for is that there are certain businesses that have been impacted. You can't control the churn in a business that's servicing restaurants, right? I mean, what can you do about it, for example, right? So I think you have to sort of look at the underlying strength of the business. What we are noticing, our business is completely SMB business, and their new bookings practically went to 0 in March and April. Okay, but they quickly regrouped, changed the value proposition, and started to get that V-shaped recovery going. In the later months, in like July, August timeframe. And they just raised their Series C at $300 million valuation on a not a very high revenue run rate, but the fact that they had figured out a different way to address the customer needs that put them in a slightly adjacent business, servicing the same clients, but started to take up their revenue in a nice way. Made the VCs feel extremely comfortable to put a very large round together. So I think that innovation ability in this downturn, where the companies actually rethink or reimagine their business models and come out stronger, right, is what we would be looking for in an investment there.
I'll tell you the things that don't work for me and the things that work for me. The things that don't work for me is let's talk, this is a new investment. So it's not a company that I've already invested in. It's a potentially new investment. Your market has been dramatically and adversely affected by COVID. Travel, restaurants, a bunch of spaces clearly have been very affected. The 2 things that don't work. We're almost there. We're going to keep to our strategy, but by the way, the market won't come back until there's a vaccine or until magically we come out of all this thing in 1 year's time, 1.5 years time, whenever it is. That doesn't work, right? Because it suspends it. You're asking me to suspend disbelief, right? You're asking me to whatever. I'm like, I'm not going to wait a year and a half to figure that out, right? Then we'll talk in a year or 1.5 years, right? You go zombie for a while or you do something else and we'll talk then. The second thing that doesn't work for me is you shoehorn like the master of all pivots that has nothing to do with your business. And it's like all of us, I call it the and now for something completely different moment, like Monty Python style, and you're like, it's like, okay, it's a different business, right? Like, cool, right? You had some traction in the previous business and now this is a different business. I don't understand how they're linked. So those 2 things don't work for me. What does work is with ingenuity, I think to what Ajay was talking about, with ingenuity, you figured out a tweak to your model, either a business model or go-to-market or pricing that actually works even better with COVID, where COVID is, the time we're in is a fuel to that, right? And we've seen guys figuring it out, right? Changing the way they were going to market. I'm actually not an investor. I'm an advisor in a company that's very focused on cleaning services relating to Airbnb, home away type services. And they figured out, actually, there is an angle here for us to get this, right? Because now actually the hosts also don't want to have contact with the cleaners. And so because their platform does allow for a lot of virtualization around checklists, et cetera, it was a really good way to sort of prop that up as a service and actually use that as a marketing ploy to get more out there in the market. And so actually they've been growing steadily when they should be getting killed effectively right now in the market.
No, and the harsh reality is, if you are obviously getting whacked by COVID, for the most part, we're just not paying attention, to you. I mean, in terms of new investment opportunities. And again, it's pretty quick. Okay, it doesn't make sense now. The flip side, is pointing out is, we've got a flood of companies that were doing COVID plans, right? And, from face masks to ventilators to forget it, right? So if you're a COVID dependent play, we're also saying, forget about that. And then sort of in the middle of these guys like, enterprise software, right? So enterprise software, depending on where you fit in that world, probably you got hurt a little bit by COVID because decision-making cycles slowed down. But on the flip side, sort of the digitization process seems to be accelerated. So the clever, the best entrepreneurs are the ones who are figuring out the nuance of how the field has shifted and are adjusting to that nuance and are showing that they have that insight that, we can play in this new game and playing, in this new way is actually going to be even better for us in terms of accelerating our success. So that's the way we see, the intersection of entrepreneurship and COVID is this combination of resilience. You got to have, resilience doesn't mean you just endure it. Resilience means you figure out a way to, work
leverage,
and flexibility. This, you're constantly listening and thinking and figuring out how to adjust.
Just to add to what Bill just said, adversity brings in a lot of strength. And how forceful are you during these tough times? And that's going to be some of the biggest companies which started during depressions and economic downturns have been really successful, like Uber and so many examples like that. So I think this is a great test of time. Now, I don't think there's one single factor. And I just said churn because from churn you could actually understand what went wrong and what is it that the companies did not, the customers did not like that you could probably change and try to bring them back in or sustain them. I don't think there's one single factor during these tough times that a company can control. I think it's an overall thing. It's not just cash reserves. It's also the way of doing business. It's also, pivoting and innovation and new ways of doing it. It's also, the people you hire and how you can control that. This is a whole thing. It's the whole enchilada. I think you need to focus on the whole thing, get through this tough times, and I think you'll just be a better company in the good times.
I think it may give some comfort to the person that asked this question that some of our companies that have leveraged COVID naturally, like one of them is a company called Gobble that delivers food to home, meal kit. The business has tripled in the last 6 months. Their fundraising is actually not easy because people are questioning what will happen afterwards, right? So their challenge is, how do you leverage this opportunity where you have gotten a lot of new clients to change their behavior essentially, right? To cook their meals in a different way. How do you make sure that you can retain a large percentage of that, right? So you continue to grow after that. So that, so it's not as if people that are doing well because of COVID get a break in terms of fundraising.
Yeah, exactly.
I imagine part of that deals with sort of what your investment horizon is, right? You're looking for companies to grow and scale over 5, 7, 9 years.
All of us are.
That's why if it's a boon, as Bill said, you can't just get on that wagon if it's COVID dependent. That's COVID hopefully will not be
But
around.
even if it's not COVID dependent, I think Ajay's point is a very nuanced one, but a very important one, which is if it's really doing well, but there is a big effect of COVID because people are at home, et cetera, like gaming, for example, debiasing the numbers, the best VCs will be very cautious, right? They'll be like, okay, what's the risk here? Because this could just fall off a cliff if people just change their habits in a year to year and a half's time when this thing gets a little bit better, right?
But I think looking at it more positively, there's a huge opportunity to change that habit for the long term, right? So
exactly,
which is the bet. So
exactly.
The other point is if the companies have taken a new normal here, maybe that's going to stick around, and that could be the way they're going to operate going forward too.
Exactly.
Yeah. So sticking with sort of the theme of COVID for the moment, could each of you share a little bit about how the funding ecosystem has changed and what you've seen? I know deals are now still getting done, and in fact, actually in the last quarter or so picked up, or arguably picked up. It was different than maybe Q2. But how is the deal flow changing? How are you sourcing deals differently?
I do. I get a lot more top of funnel via LinkedIn, emails, whatever. I mean, I think the whole team, our associates, principals, etc., are getting a lot more top of funnel. We've slightly changed our process. I think top of funnel, we're being more aggressive about filtering, but we're spending less time on each deal. I mean, to Bill's point, maybe not 20 seconds, but a couple of minutes, right? Looking at the pitch deck, going through it, and understanding their numbers before we decide to jump on a call or not. So we've changed slightly the process to be have more top of funnel, which we need to have, but at the same time filter it much more aggressively for a first call. The part we are trying to find a lot more hacks around, we found a few, is around deal making. So once you're close to the end of due diligence, you do need to meet teams, you do need to go to their offices. If it's in proximity, that's easy. If they're not in the Bay Area, or if they're not within driving distance, it's a little bit trickier right now. So finding hacks for that, how we figure out their office situation, their dynamics, and we've used a lot of that in the past in person. We had a lot of hacks that we used to deploy for due diligence, and now how does that change? I don't think we have a great answer yet. We've done some stuff right, but it's still pretty much work in progress. Definitely seeing a lot more top of funnel, a lot of noise, a lot of crappy stuff as well, top of funnel. So just be careful, right? And how do you go below that noise level? Ajay, I think, mentioned earlier, be careful with the intros you get. Warm intros, qualified warm intros matter a lot. So if you are just sending LinkedIn something, I'll take a couple of minutes to look at it and then I'll make a call. But that's it, right? That's the best case scenario.
Yeah, the Series A's are tricky. If you look at the pitch book data for the last few quarters, the seed ecosystem has held up in terms of number of deals, even though the deal size has gone down. The growth stage ecosystem has actually grown during COVID because it's easier to make decisions. You have deterministic numbers, and generally the companies that are sort of breaking out and destined to be unicorn are easy to identify for all of us, right? But Series A is kind of like tricky because you're still not out of the woods in terms of proving your market traction for the long term, but you have shown some initial traction. Now you need the fuel, like $10-20 million to take it to the next level. So we have certainly, honestly, we've been doing more seeds because it's like easier. We can put small dollars in and seed those companies in this period. And then for Series A is the ones that, we're looking at, we are trying to have, personal meetings. I was mentioning, Jason, that I was initially having meetings with masks on in our office. But now, I find it actually easier to just do it in my backyard. So you don't have to put the mask on, have a little distance, do it in the evening, have a beer out so you can have beers and get to know people. But it's definitely, I think that the overall investment pace in Series A's and B's will continue to be lower than what it was before. I think the seed ecosystem, the deals will be pretty robust, but dollar size will probably be low. And I think the growth ecosystem will actually take most of the dollars for the next few quarters is how I see it.
Yeah, I think the seed funnel, the Series A funnel has tightened up. There's a lot more seed out there. And I recently saw this company apply and they said post-seed plus. I mean, it's like a new term. So everybody's extending their seed as much as possible, knowing that, seed stage investors kind of see they like the metrics they see because obviously they're a traction company, they have enough, the metrics, they were ready to go for Series A, but decided not to right now because Series A is a lot slower and it's a lot more friction. So we do see that. And that said, Nuno's point is a lot of noise. So there's why is there noise is because it's become easier for entrepreneurs now to go and reach investors. I mean, you don't, lack of maybe even travel. You don't even have to drive. It's easy to probably apply. It's easy to get onto forums and pitch. There are gazillion pitch sessions going on, whether it's angel groups, whether it's private groups, who let you come in and pitch. And so I think there's a lot more deal flow. So there's not a lack of deal flow. There's flexibility, however, to do these meetings, do these due diligence without less effort. You don't have to have actually, structured sessions and everything to do that. As Ajay pointed out, you could be in your t-shirt and your gym shorts, and you're still doing a diligence meeting with your partners. So there is flexibility, and I think that's a great thing.
Yeah. Yeah, and I agree with the sort of the character of the market. It is actually, it's actually stunning that the market has held up as well as it has. I mean, I'm still kind of amazed and to, to some extent skeptical. I mean, everybody assumed that prices were gonna come down significantly and noticeably. It really, it
No.
really haven't, come down noticeably. And to the noise point, it's kind of, everybody is running twice as fast just to stay in the same place. And so the sort of the speed at which everything is going, because now you don't have to get in the car and drive or arrange a lunch or arrange a dinner. You can just do zoom, 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 zoom. And it is kind of overwhelming in that sense. But it does, in terms of the dynamic for our entrepreneurs, understand, I think it's pretty consistent that it is just taking longer. It's taking longer, obviously, because of COVID is part of it. And, and part of it is also because of this interaction. But we've decided that, we may skip a lot of this visit stuff in the future because I tell you, I mean, intuitively, we think you got to go to the office and you got to sit down. But having done a lot of global investing, this Zoom makes, it doesn't matter if you're in Israel or in San Francisco. I mean, I'm loving it in that sense. We still depend, we depend upon someone we trust to vouch for, everybody in every part of the world. So that's still part of the dynamic. But it'll be interesting to see how many of us go back to these painful, time-consuming in-person meetings when you can, schedule the Zoom and just, so I think for the entrepreneurs, again, be prepared for the fact that it is going to take longer.
Yeah.
And that means you've just got to be even better at managing the process than maybe you were before, but you've got to stay right on that process, because we are, as you're hearing, we're getting banged on, by all sides, our portfolio companies, new deals, all this other stuff. So, you got to stay on top of the process and, keep that, that sales progress through the pipeline, keep that going and manage it with discipline, because, it'll be easy for us to get distracted and focus on someone else.
Well, thank you very much, panel. We've reached the end of our hour and a half today. If anybody has a brief comment at the end they want to insert, please go ahead. Otherwise, I want to give one more opportunity for each of you to say the best contact information for you, and then I will close us out.
Again, it's reichert@garage.com. That's also on our website. Please don't try to communicate with it. We can be friends on LinkedIn, but don't try to communicate with me on LinkedIn. Okay.
Yeah, at Ajay Chopra DM is probably great. I think I would just like to say one thing. Despite all that we have said, I don't think there's any better time right now than right now to be an entrepreneur. I mean, there is so much stuff happening in biosciences.
That's right.
The whole space area is just beginning and happening. I think cybersecurity is going to be a mega area. There's so much innovation in medical sciences and healthcare IT. I mean, it's a terrific time. So just like imagine what you can do and be bold about it and really believe it and make sure it's differentiated. I think that's the message I would give you.
The adversity and the pandemic has given us so much opportunity, and that you can innovate. It's a new market opening up and new ways of doing business. So there's new problems to be solved. Just keep innovating and open up your entrepreneurship hats and go at it. And we would like to see more of you apply and reach out to us. Best way to reach me is kumar@elevate.vc. So looking forward to it. Thank you.
And the best way to reach me is on LinkedIn, just mentioning that you were on this panel. Nuno Goncalves Pedro, there's a bunch of Nunos around the same time in Portugal, but Nuno Goncalves Pedro, there's really one. And as a plug, special props and a plug, you can watch my Rejection and Adversity as a Path to Growth video on YouTube, something that I'm very passionate about at a personal level, but also as Kumar and Jay were mentioning, I think this is a particularly amazing time to change positively, to use adversity as a positive catalyst.
Well, thank you very much, Nunu, Kumar, Bill, and Ajay. I'm Jason Putnam-Gordon. You can reach me at jgordon@pulsanelli.com. We apologize that we couldn't get to every question that was posed today, but thank you for attending. Thank you for Idea to IPO, and we hope you have a wonderful afternoon. We'll send you the
Thank
video.
you, Jason. Thank you, everyone.
Thank you.
Be
Bye-bye.
safe,
Thank you.
everyone.
Great seeing you all.
Bye-bye.
Bye-bye.
Bye-bye.